Stay tuned as we find out if the sell-off in healthcare stocks creates a buying opportunity, and if now is a good time to buy Disney after the recent proxy fight. Good afternoon, fellow investors, and welcome back to InvestTalk. This is our Wednesday, April 3rd, 2024 edition. I'm Justin Klein, and back with us today is Luke Guerrero. Thanks for being back here. I know you had a few fits of allergies.
I am unfortunately allergic to the world, so every time pollen starts increasing in Los Angeles, which is mostly all the time, I tend to sneeze every 2 seconds until I fall asleep. So I'm feeling better today, thankfully, and happy to be back.
So most people get excited about the start of spring, but you dread it.
Absolutely hate it.
Well, luckily I don't fall prey to those those issues. But glad you're back with us in time for the Elite Eight. Look, we're down to the final 8 contestants in the InvestTalk Market Madness contest. Only 8 companies remain, and we're going to get to the matchups for today, including today's winners. And today's winners were AEP, that is the American Electric Power, a utility company, beat out Dominion. And then Marathon Petroleum beat out, who is it? The toilet paper company, Kimberly-Clark. There we go. And Marathon Petroleum did very well because oil did very well today. So they will join in the finals. This is the finals of each bracket. And there will be the finals for the income region. So we're going to break down all of those matchups later today. And to stay in the loop as to which companies win, who are the winners, we're going to send out a new updated top 10 list. We did that, I believe, yesterday, day before or so, the top 10 winners of the contestants that submitted their results or submitted their brackets. And we'll give an update here, I believe tomorrow or Friday. I think, tomorrow after the Elite Eight is done. So you'll get another update there. And download each episode to stay up to date on the results. Now, before we talk about the market performance today, Luke, and run down some show topics, we are going to hit our first caller question now.
Good morning, Justin and Luke. This is Josh Works calling from England. I just had a quick question about ticker symbol BTG. Since gold prices are doing so well and have kind of a bright, short-term future here, medium-term future, I just kind of wanted to get your take on this stock. I've been in it and held it for a long time, kind of through thick and thin, and just wanted to get your opinion if I'm wasting my time or if I should kind of keep holding on here for the next bit of time. I appreciate it. Thanks.
All right, looking at B2Gold, this is a small cap gold producer, low cost international gold miner. They have mines in Mali, Namibia, and the Philippines, and exploration projects across the world. So not in your typical, shall we say, stable regions of the world. That's also probably why they are a low-cost producer. But that brings in another layer of complexity and risk with the geopolitical concerns around it. Luke, is it cheap enough despite those potential challenges?
Well, it certainly is cheap. It's trading at a price to book of 0.9, so it's trading less than the value of its assets. Its price to earnings on a next 12-month basis is 10.2, which is pretty modest. And its sales growth over the past 5 years has been 10.5% annualized. But the problem with that is most of that seemed to be from 2019 to 2020. That kind of stabilized over the past couple years, and they're actually projected to make less in revenue this year than they did last year. And because of that, their profitability has been suffering. Though interestingly enough, their cash flow has been consistent. One thing that I like about the company is it's got very minimal debt. But for me, if you're trying to take advantage of what's been going on with gold prices, with precious metal prices, I would probably pick a company that is more broadly diversified outside of these destabilized regions. Mm-hmm. Because like you said, this is certainly led them to have varying profitability from 24 cents in 2022 down to 1 cent last year, hopefully back up to 22 cents. This segment is already volatile enough that given this specific type of business and where it's practicing, it seems just a little bit too volatile in terms of its revenue and its profits.
Yeah, I would like, I'm fine with having a company that has a little bit of exposure to these more volatile regions, but that I don't want that to be the bulk of the business, because anything can happen in these third world countries, and that's where these are for the most part. Philippines isn't, but most of these other countries are. But I don't, like I said, I want it to be more in stable regions: Canada, United States, Europe, etc. So I know you've held it for a while. I just think they're better horses. I think it's a great space to be in right now because I think gold is just getting started. But I would be moving into another miner. Thanks for the call. There will be a lot of ground to cover over the next 40 minutes. Our main focus point is about healthcare stocks. They've taken a hit recently due to the lack of boosted payments for private Medicare plans. So we're going to talk about how these health insurance stocks are reacting and whether their Medicare business is suddenly in jeopardy. So we'll talk a little bit about that. We also have some voice bank questions ready to play. One is on Old Dominion Freight Lines and Fifth Third Bancorp. We also are going to touch a bit on what it takes to retire. There's a new survey out of Northwestern Mutual, and it surveyed people saying, okay, how much do you need to retire? What's comfortable to you? And there's a new updated number, and guess what? It's higher than it was just a couple of years ago, so we're going to look at that. Also, the jobs market remains relatively robust, and there's increasing evidence that there's one main reason for that, and that is immigration. So we're going to talk about that. And if we have time, we're going to maybe touch on UK stocks, the UK region, and why stocks there are pretty cheap. So that's what's on the docket for us today. But of course, most importantly, it's your finance and investment questions. So you can call now at 888-99-CHART. Now let's take a look at the market today, Luke. We had a pretty decent sell-off across the board yesterday, but a bit of a bounce today. Large cap value definitely was the weakest part, but a modest bounce, like I said, across the board. It was interesting. Jerome Powell kind of came out and put a kibosh on a potential rate cut in June, it seemed like. What did you see today, and what was your reaction to those comments?
Yeah, well, like you said, equities are mostly higher. The Russell 2000 was up almost 55 basis points, up 54 basis points, so it was a good day for small caps. And a lot of that was helped by some softer ISM services readings following the hotter manufacturing reading earlier this week. Precious metals and home builders had a good day today. Gold was up 1.5%, now up for 7 consecutive days, which is something that's certainly interesting and something to watch, given what it says about where investors are putting their assets. But overall, I mean, I didn't read too much into what Powell said. Certainly, it didn't move the market that much, given that the S&P was up 11 basis points, although it was down from where it was earlier in the day. But it didn't really get up that high before those comments. So, overall, I think generally the market's probably waiting to see what happens with employment on Friday, CPI next Wednesday, and really the start of bank earnings season, which comes next week. Obviously, bank earnings tend to be the harbinger for what's to come in the economy, so a lot of eyes will be on that next week.
Yeah. We did kind of fade, though, throughout the day, kind of late morning. The market peaked, and we faded. So I think there was some reaction there, but to your point, what's most important is going to be the jobs number on Friday. The ADP number today was decent, so that could portend to a decent number. Although those two numbers tend to not be that correlated, unfortunately. So yeah, there was I think some reaction, but yeah, the Fed is data dependent. They say that many times, and therefore their data is on Friday is probably more important than kind of a wishy-washy statement that they came out with today. So. Very interesting to see how we progress into the end of the week. Let's squeeze in another listener question now.
Hi, Steve or Justin. My question today was about Fifth Third Bancorp, ticker FITB. I don't have any exposure to finance, so I was just looking to see if this is a bank that you guys think could be good, and if so, at what price. So just whether you think this was something that would be good to add a position, or if I should be more patient, and if I should be more patient, kind of a good time frame to wait before getting in. I'm looking for your answer on the podcast. Thanks as always, guys. Bye.
All right, looking at Fifth Third Bancorp, and this isn't one of the big mega banks, but it's also not one of those tiny banks either. Luke, we had a call yesterday on a company or on a regional bank that had a market cap less than $1 billion. This is $24 billion. So, we've been saying for a while that the regional banks are certainly not where you want to be, but this would probably qualify more as a mid-sized bank and has a lot more geographic diversity than your average regional bank and heft in size. So do you think this is large enough to qualify as a bank that's safe enough to play?
Well, maybe, right? I believe the regulatory threshold for those large banks that have to follow the capital controls of the Fed, at least before the collapse, was $50 billion. I could be wrong about that number, but I don't know if it necessarily falls under those large banks, right? It is a medium-sized bank. Certainly the market seems to think that there's not as much risk as some of these smaller regional banks, given its price appreciation since October. It's up 35% from a year ago, though you got to keep in mind that was coming out of the regional banking crisis. So certainly that had to do with its price appreciation. But in terms of relative valuation, it's at a price to book of 1.4, which is pretty reasonable. Its forward-looking price to earnings is at an 11. The thing about these banks is you really have to take a deep dive into their balance sheets to fully understand the risks that you're taking on. And without doing that, it's difficult to give a recommendation. I would generally stay away from the smaller banks. If you're looking to get exposure to financials, I'd probably steer more towards the backbone of the financial system, the larger banks, insurers, stuff like that.
What I do like about this bank, though, like you said, it's mid-size. It's not the mega caps, but it's mid-size, so it has some heft to it. So it's a bit more diverse. And if you look at the regions, the states that they're in, it's pretty much the Midwest. You have Ohio, Kentucky, Indiana, Michigan, Illinois, Florida, Tennessee, West Virginia, Georgia, North Carolina. This is where a lot of people are moving to. They don't have your traditional exposure to these big cities where these office buildings are losing tens of millions of dollars in value every single year, every single quarter, because people are just moving away and companies are moving, to cheaper regions of the country. So I think from a secular standpoint, a lot of people and businesses are moving to these regions. So I kind of like that. And also, as you said, the market's not pricing it like it's risky because relative strength is 85. The banking index itself is 75, so it's outperforming the banking index as a whole. So if you don't want to buy one of the mega caps, I think this qualifies to me as a type of name to take a risk on. So I still don't love banks, but I wouldn't mind purchasing Fifth Third. Thanks for the call. Now, our main focus point today is about why healthcare stocks are taking a hit. And this was really yesterday, and it was all about Medicare supplemental plans. Humana, which is the health insurer that is most dependent on these private Medicare plans, known as Medicare Advantage, it fell 10%, and there were others within the space that fell anywhere from 3 to 8%. And this puts really pressure on these companies who are dealing with higher medical costs, right, input costs to what they're covering, and hurts the margins and long-term profitability. Despite there's a lot of growth drivers, right, within this industry, boomers retiring and more of those boomers going on these supplemental plans. About 50% of those on Medicare, a little more than half, enroll in these plans. So, Luke, is this something, do you think the market overreacted a bit? Because the reality is this was a small miss compared to expectations, right?
It was a small miss, but it does affect a lot. And so it does affect the profits of these insurance companies, but down the road, it'll also probably affect what services are available to the people that are enrolled in these plans. So did it overreact? Possibly. I think the market probably hasn't fully digested what this type of pay difference means in terms of care, because that changes the input costs, right, of these companies just as much as it changes the reimbursement and the profitability. So I think it is a monumental change, or not really a monumental change. It's not a monumental change like they say it is in terms of the miss, but there certainly will be downstream effects towards these companies.
Yeah, and the Center for Medicare and Medicaid Services were the ones that set these rates, and they raised rates 3.7% year over year. And that was in line with the proposal in January. But typically, these agencies raise it higher than the initial proposal. So that was kind of the miss here. And that's why I say I think maybe the market did overreact. Yes, it matters, and it's going to impact margins. But a 10% drop for Humana is pretty big. Now, Humana's already down a lot. So there's market kind of building expectations that this business is not going to be as lucrative as it was before. But, as the market, I think, getting over its skis and believing that it was going to raise these rates more than the initial announcement. And so maybe going forward, if it's going to be more conservative, the market will be more conservative in what they expect, and hopefully over time make this business a little more predictable as well. So I think in certain instances, not widespread, this can be a buying opportunity in the space as a whole. All right, let's head over and cover one of our latest YouTube comments, which if you leave a question in the YouTube comments, we potentially will answer it on a future show. So we're picking one comment each day to answer. And Finite Anarchy says, I am wondering if you could discuss Disney. I bought a few shares when it was at its low last year in the high 80s, low 90s. Currently, it's at 121. Just for reference, everybody, today it was down $3.84 to about 119 at the close. I know it recently started reissuing its dividend, but I don't think I've seen much from Disney that changed in terms of how the business is doing compared to late last year to justify the price jump. Would you buy Disney at current prices? What do you think about it now that they've started up the dividend? Luke, today, the big news on Disney was that, was it Nelson Peltz lost his proxy? Lost his proxy fight to change leadership at Disney. So Bob Iger won. The market obviously didn't like that because, like I said, it was down $3.84, and the market has been clamoring, and this stock has been rallying on a potential regime change at Disney at the top to change directions for the business that, frankly, has gone the wrong way since basically the start of the pandemic. So, should he sell now, or, will there be another activist that comes in and also puts pressure on the board and gets new leadership in?
Well, I don't necessarily think that it's a bad thing for the company that one activist investor wasn't able to rally enough institutional investors. Like, you got to keep in mind, right? The board is elected by shareholders, right? And so the shareholders of this company decided that they wanted to go with Bob Iger, who does have a history at the company, even though he's semi-retired one time, came back, whatever. They wanted to go with current leadership. And the reason why Disney's price has been rising after the end of last year was because they have made some good moves, right? They've increased the price of their streaming service. They've gotten out of some unprofitable IP they have. And so their losses on streaming have gone down. Their profitability has generally gone up more. So I still think there's a lot to do. I wouldn't necessarily take a loss to a victory to an activist investor as a downside for a company.
Yeah, I think there has been some improvements at Disney, but they still have a lot of issues. And one of my main issues with Disney is on the movie front. They still kind of are squeezing the Marvel universe, and I know there's been a lot of negative feedback on some recent movies. And it just feels to me, this is what it feels to me, that they are focusing too much on profits and not enough on long-term kind of trajectory of their characters, their brands, etc. And that's what worries me the most about Disney. It feels a lot like a finance company, a CFO is running the business as opposed to a true CEO. On the next Invest Talk, we'll look into this question. Are 53% of Americans behind on retirement planning and saving? Here's the reality. Many low-income households are burdened with competing financial priorities. We'll break down that story tomorrow. Now, that's tomorrow, but coming up, we're going to look at the market madness matchups, but let's play a caller question now.
Hi, greetings to Steve, Justin, and Luke here. Steve, I hope you're doing well and wish you the best. A longtime caller here from the Midwest. The other week I heard Justin talking to a fellow caller about a trucking company, and you mentioned that there were some better ones out there to look at. I've been watching one here for quite some time, and it did a split here the past week, and I don't know if stock splits really mean anything or not, except they lower the price down. But anyways, the company is ODFL, I believe. It's Old Dominion Freight Line. It's a pretty big one, so I'm sure you guys know of it. I'm just wondering, would that be a better freight line, would you feel, to put some money in and leave it there for a few years at least or more, kind of a long-term investment? They don't really pay much of a dividend, I notice, but it seems to be a pretty solid company and it has some growth potential. Please let me know what your feelings are, if this would be a good company to be invested in, or if I should pass by this one and look for something else. Thank you for your time. Have a great day, you guys.
You know, Luke, we have some smart listeners. I don't know if you were doing the show that day, but we had a caller that asked about a trucking company or a transportation company. I forget exactly which one it was, but you know, it was fine. It was okay. But I said there's a bigger one that's much more consistent and much more profitable. And this caller sniffed it out. I can't, due to rules, I can't say which one it is right then, but you can call and you ask about it. And this is the one, Old Dominion Freight Lines, ODFL. This is just a powerhouse. Profitability right now, return equity is 32%. That's a bit higher than it is longer term average, but it's profitability long term is incredibly consistent. It has a very clean balance sheet, pretty much no debt. It's trading at a bit of a premium, but hey, I'm going to pay a premium for a fantastic business. The technicals are good, not amazing, but good. You're right, the split doesn't mean anything to me. It's just the share price, but it's more about the business. And you said it doesn't pay much of a dividend, 0.4% dividend yield. And this is exactly what I talk about, Luke, when people focus way too much on the dividend and not nearly enough on the business. The profitability here, return on invested capital, 31%. That is fantastic. How many people actually go and look at that when they're looking at the business? And how many people are just looking at the dividend? Oh, it's paying 4% or 5%. And they're going to pass this one right up because its current dividend yield is 0.5%. So am I off here? Is this... maybe I'm too excited about this name, or the fact that this
very excited about this.
This listener sniffed it out. I love it.
No, I do agree with you on multiple fronts. One being we have some very smart listeners. Another one being that it's an excellent company. But as always, buying into a company and where you exit a company, it matters just as much as whether or not the company is good. And so looking at the price to earnings forward-looking, it's at a 32. For me right now, this company's pricing in some extraordinary long-term growth that maybe would lead me to believe I want to hold off a little bit before I buy into it. But, you know, at the end of the day, you don't find excellent businesses all that often, and this is an excellent business.
Yeah, it's an excellent business. And I give this, this is one of those ones you buy and hold because of that long-term track record. I don't think that trucking is going anywhere, no matter what technology does. Things still need to move around, and this is a fantastic company. That's Old Dominion Freight Lines. ODFL is the symbol. Now, Luke, let's talk about this exciting Elite Eight. This is the finals of each region tomorrow, and the first matchup in the Elite Eight, the new economy region, and that would be Vertiv. VRT is the symbol. And that had a fantastic day, up $4.58, over 5%. And then that's going up against Cytokinetics. Cytokinetics, that was actually down today. I have to go with Vertiv, right? You have to go with that momentum.
Yeah, I have to go with Vertiv too, especially that Cytokinetics. Wow, I don't even say the name anymore, so that's why I hope it loses.
Cytokinetics,
But
there you go.
Cytokinetics, it's a biotech name. There was some talk today, like you said, some inferences that you could make from Jerome Powell that maybe we're going to have delayed rate cuts, and that would adversely affect these biotech companies. So I think I got to go with Vertiv.
Yeah, I agree. And then we have the matchup in the old economy region, the finals here, and that is Century Aluminum, CENX. We know the material space is on fire, up again today, 55 cents, up over 4%. And that was again, and then we're going up against Core and Main, the powerhouse, and that is just powering higher again today, up $1.98, also up nearly 4%. So I don't know, it's a tough one. Both have pretty strong momentum.
Core and Main.
Core and Main, you're just
not going against Core and Main.
Yeah, Core and Main just is an absolute powerhouse here. So I'll go with Core and Main as well. And then the finals in the consumer region would be Mettler-Toledo. Mettler-Toledo. You know what's interesting about this? Before we get to this, are there any large caps here? There's not. These are all smaller mid cap names. Just shows you. Maybe this is the time where those small caps are doing better.
Did we just inadvertently talk about a small cap premium?
I know, right? So Mettler-Toledo was up decent today. It's a $1,300 stock, so a $9 move is not that much. And then versus Equitable Holdings, EQH, also up today. So all these names just are showing very strong momentum. I don't know, this is a tough one. EQH, they're the ones that they're the financial advisory service, and when asset prices go up, they tend to do well, right? Versus the other one, which is Mettler-Toledo, that is a company that, correctly, precision instruments for laboratory, industrial, retail food applications, etc. I'm gonna go with Equitable Holdings.
I am too, just because looking at relative valuations, I'm gonna do some fundamental looks here and say that Mettler-Toledo is a little too expensive. So I think I'm gonna go with EQH on this one.
Although valuation is a terrible predictor of tomorrow's performance.
It is, but I got to go back to my roots just for one of the
There you
picks.
go. All right. And then the finals for the income region, which is the results of today's matchups. There's American Electric Power. That is a utility company versus MPC. I'm sorry. We're wrong. AES, that's what it is. AES, I said AEP. It's AES is the symbol. Up going against MPC. Marathon Petroleum versus AES. Marathon, here's my thing. Marathon is overbought. It faded for a lot of the day. Energy stocks, I think, are bits overbought. Whereas AEP, sorry, I keep saying AEP. AES, there we go. AES
Different
was
utility.
up today. Yeah, different utility. AES was up today. It's consolidation. I'm going to go with AES tomorrow. I just think MPC is a little bit overbought.
I'm going to go with MPC because there's some potential destabilization in the Middle East between Iran and Israel. Could affect oil prices. Oil prices go up. Marathon Petroleum does well.
Oh, there is. Okay, I did not hear about that. Where's that news? Can you tell us more
it was,
about that?
I think it was over the weekend. An Israeli strike killed Iranian military commanders. I think it was in Syria, maybe. And then today, Iran was saying that they were going to do some things. So there's always tension in the Middle East.
There's always tension in the Middle East.
Yeah, so I'm going to go with the oil company here.
Fair. Okay, well, those will be the matchups for tomorrow, and then we will have our Final Four on Friday, and then our championship matchup on Monday to line up with the championship in the NCAA tournament. We have the Final Four this weekend. All right. Luke, let's talk a little about UK stocks. And as of January, UK stocks traded at a 49% discount to US stocks, which would be the largest gap in valuation going back to 1988. 1988. And I think there's a few reasons for this. Obviously, if you think about tech stocks, how many tech companies are out of the UK that you can think of that are large and well known? I'm waiting. Can't think of any.
Oh,
can you think of any?
Yeah, I can't think of any either.
Yeah, exactly.
I thought that was a rhetorical question.
Yeah, exactly. At that point, it's a rhetorical question, and then I think that's one of the big reasons, right? The valuations in U.S. stocks are heavily weighted towards those big tech names that trade at very high multiples, whereas London companies tend to be in two sectors: banking and energy. That's what London is mainly known for historically, and those companies tend to trade at lower multiples, and so that's part of the reason. So I think U.S. stocks should trade at some sort of a premium. But is this a giant, opportunity flag hanging out over there in the UK, driven by this dispersion between the types of companies in each market as well as Brexit?
I think both. I think that generally speaking, international stocks tend to be undervalued relative to U.S. stocks, and that's been because of the asymmetric recovery, right? So there are a lot more opportunities out there within international markets to buy undervalued companies. But specifically within the UK, I think you nailed it with that last bit of what you just said, which is a lot of this has to do with Brexit, because the UK, like you mentioned, was a hub for energy, a hub for banking. But the reason it was a hub for banking was because it was essentially the economic center point of Europe. And so with pulling out of the European Union, a lot of that ground was ceded to Frankfurt, and a lot of that ground was thrown back to the US, to New York, for that, the Western Hemisphere's financial capital. So some of these trends are secular trends that probably are going to depress valuations of these companies within the UK for some time. But that isn't to say that there aren't some opportunities to invest in companies that are undervalued.
Yeah, and if you look at how advisors are positioning their accounts, their client accounts, a recent survey by Bank of America last month found that fund managers remain net 27% underweight UK stocks and have been that way for a couple of years. So clearly there's room for, if there's any momentum, move for allocation towards UK companies, as well as the fact that the UK economy is holding up better than most economists had forecast. So from an earnings perspective, they're not plumbing to new lows like you're seeing in Germany in many instances, right? The German manufacturing industry is suffering mightily under higher costs of energy caused by the Ukraine war. And the UK is not nearly as reliant on that as we talked about, right? And so, those two factors tell me that there's a lot of opportunity over there, and you certainly should be paying attention if you're trying to get some more foreign exposure. Now, this is InvestTalk with more than 58 million downloads. Thanks to you. And our work continues after another caller question from 888-99-CHART.
Hello, InvestTalk. This is Carl from Florida. I would like to get your assessment of a Canadian company, TerraVest. Trades on the Toronto Stock Exchange under the ticker symbol T as in Tom, V as in Victor, K as in Kellogg, .T0. Also, kindly pass on my best wishes to Steve. He has been greatly missed, and I sure hope his return to the microphone is very, very soon. Thank you very much. Bye now.
Well, thank you for that. I actually saw Steve on Friday, and he's hanging in there. So, and I've given him all of your well wishes, and he definitely appreciates that. Now, looking at TerraVest Industries, a Canadian company, and they manufacture home heating products, propane systems, natural gas liquid transportation vehicles, storage vessels, energy processing equipment, fiberglass storage tanks, etc. And this stock is on a tear. Near the end of last year, it was trading in the mid-30s. Now it's at 68. Is he too late to the game, Luke?
Well, it's pretty expensive. It's trading at the upper end of its 5-year range in terms of price to book, but that could be justified. Over the past 5 years, they've had an annualized growth rate of 20% in sales and 22.5% in EBIT and almost 20% in net income. So certainly for companies that are having consistent long-term growth rates, it can justify more elevated valuation multiples when you're purchasing it. And that being said, I mean, its price to book is only at 5.1. It's not crazy egregious. It's trading at a price to sales multiple of 1.7. I'm not seeing anything that's been a flag for me. What are you seeing?
I don't have any issues with it. Obviously, I like the business. Technically, it's just very overbought. So I would be patient. If it pulls back into the mid-50s, I'd probably pick it up. But I think it's overbought right now, and I'd be patient on it. Now, let me alert you to a new InvestTalk Classroom episode that we just published on how the Fed's policy shift will impact the real estate market. Join me and Luke for episode 18 on how a Fed pivot affects the real estate market. Just search InvestTalk Classroom over on YouTube. Now let's play one more question now.
Hey guys, it's James calling from Georgia. I wanted to go over something with you. Saw 33 undervalued stocks to buy for quarter 2, 2024. This is on Morningstar. So we're just going to go through all 32 stocks real quick. No, I'm joking. We're going to look at one. I just wanted to ask you about one stock that I'm looking at, and it is going to be Entergy ETR. If you could run that down for me. Big fan of the show. Praying for Steve. Hope you guys have a great day. Thanks.
Well, 33, those lists, I mean, I think they can help, but they're definitely not the end all be all. But Entergy is an interesting one. $22 billion market cap. It's a utility company out of Arkansas, Louisiana, and Mississippi. Would you say it's undervalued, Luke? The relative strength is not that great, 44.
You know, it's tough to evaluate relative multiples of energy companies, or rather, utility companies, because they don't operate in the same way that a normal company would, right? So can't really look at their price to book. It's not going to tell you anything about it. But in terms of price to earnings, which takes into consideration cash flow, profitability, it's at a 14. I mean, it's mid-range. It's kind of actually the lower of its 5-year average.
Yeah.
Utility companies, you're not looking for much price appreciation, right? They're income investments. Its dividend yield is 4.3%, and it's been consistently above 3% for the past 5 years. Yeah. You're never going to excite me with a utility company. I think it's pretty fairly valued.
Yeah, I would say it's fairly to modestly undervalued. So not a bargain. And it's a utility company, like Luke said, it's not going to knock your socks off in performance. It's all about that income. It's more like a bond proxy. So it depends on if you're trying to take low risk in the equity markets, this is probably a decent way to do that, but you can find much better opportunities elsewhere. Now, lastly, let's talk a little bit about the magic number to retire. This is a new survey from Northwestern Mutual. They surveyed over 4,500 adults, and the average amount that people said they need to retire is $1.46 million. That's up from $1.27 million a year ago, and at $1 million was... that 1.46 was about $1 million more than the average person's nest egg that was surveyed. So a lot of people think they need a lot more money. And the big question is that an accurate number? I think the reality is, depends who you are. If you're wealthy and you want to maintain your lifestyle, probably not. If you're poor and you don't plan to spend a lot in retirement, 1.4 maybe is plenty. So I guess it depends, right, Luke?
Yeah, I think generally people have no idea how much they need to retire at their current quality of life. I think that's why it helps to consult financial professionals that can help you do financial planning and help you out with that aspect of your life, like ourselves. But I think a lot of this is driven primarily by people's perception of inflation, whether or not that's a justified perception. You get a top line number, and it tells you something. But what people really feel is certain things within that top line number, right? People feel how expensive it is to try and buy their first house. People feel how much it costs to fill up at the pump. So their perception tends to be a lot heavier in terms of the price pressures than maybe what the actual number is. And that's certainly weighing here.
Yeah, inflation is certainly reflected in this. And what's interesting is that millennials think that they need a lot more money, about 1.65 million, whereas boomers, they think they only need about $1 million. And so certainly it depends on your age. Now, what I thought was most interesting here was that the younger generation is saving a lot sooner. Gen Z, born around 1997 or later, are already starting on average. They're starting to save at the age of 22. The average millennial, we started saving at 27. Boomers didn't start really saving on average until 37. So while a lot of the older generation, the boomers have not saved nearly enough, you can see why. You can see why they haven't saved enough, because they started saving way too late. So that to be a lesson to everybody out there. Make sure you save early and consistently. And the recommendation is about 15% of your earnings. Contributions to your retirement accounts plus employer matches, that should account for about 15% of your income. That about does it. We thank you for listening to InvestTalk. I'm Justin Klein with Luke Guerrero, and we encourage you to tell your friends about our free downloads, which you can find anytime at iTunes, Spotify, or Google Play, and be sure to rate and review on iTunes as well. Independent thinking shared success. This is InvestTalk. Good night.
InvestTalk is a trademark of KPP Financial. Because of the nature of the interactive dialogue inherent in the format of this program, it's important for the listener to understand that not all comments made will apply to them. Specifically, nothing said shall be taken to be investment advice, or shall statements on this program be considered an offer to buy or sell security.